welcome back to our Choice of Entity webcast series. The next issue I want to talk about is an important issue, and it's the income tax on the operations of the business. Now, obviously, before anyone can go into business, they really should understand how the operations of that business will be taxed. And so it's important to understand the income tax ramifications of the business entity that you choose. So first off, your sole proprietorship. Again, there is no separate business entity in the sole proprietorship. All of the operations will be taxed to the sole owner on his or her personal income tax return. There's no separate return. It's just as if they earned the money themselves because they did. General partnerships, the partnership itself will have to file a tax return, an income tax return, but the partnership won't pay any income tax on the operations. Instead, those income taxes will flow through to the partners, and the partners will report all of that income on their personal return, and there'll be no tax to pay at the partnership level. Limited partnerships, exactly the same as the general partnerships for income tax purposes. For tax purposes, general partnerships and limited partnerships are treated the same. So the limited partnership won't pay tax. Everything will flow through, and the tax will be paid at the partner level. Corporations, it's a little bit more complicated at the corporate level. A corporation will default to what is known as a C corporation for tax purposes. And in a C corporation, the operations will be subject to a double tax. There'll be a tax on the operations at the corporate level, and the corporation will file an income tax return and pay the appropriate taxes related to its income. There will also be a second level of tax when that income is distributed up to the shareholders in the form of a distribution. That's what people think of as a tax on the dividends or the distributions coming up. So there's a first level of tax paid by the corporation on the income, a second level of tax paid by the shareholder when that income is then distributed up to that shareholder. Some corporations, some people may find it desirable to make a so-called S election to be treated just for tax purposes as a so-called S corporation, in which case the income tax on the operations will be treated very similarly as a partnership. The corporation will still file a tax return, but it won't pay any tax on its operations. Instead, the result of that income will flow through to the partners, to the shareholders, and the shareholders will pay a tax, but only one level of tax on the operations, similar to a partnership. There are rules for S corporations. Not every corporation can elect S. There's limitations as to the number of shareholders you can have and the type of shareholders you can have. So if that's a possibility, then the business owner should make sure that they're complying with those rules as well. Limited liability companies, again, the default for a limited liability company, if it's got one owner, it defaults to the same as a sole proprietorship, and that person, it's known as a disregarded entity, and all of the operations of that limited liability company will just be reported on the owner's personal income tax return, just like a sole proprietorship. If there's more than one owner, for tax purposes, it will default to be treated as if it were a partnership. So it will file a separate tax return, income tax return, but it won't pay tax on its income. Instead, all of the income will flow through to the members, the owners of the LLC, and they will pay tax individually on that income. So there's only one level of tax in an LLC, a limited liability company. However, limited liability companies can also make an election. It's called a so-called check the box election, where the limited liability company can effectively be treated as if it were a corporation for tax purposes. Meaning, if the limited liability company checked the box to be treated as a corporation, it would default to a so-called C corporation, resulting in the double tax that I just discussed for a C corporation. Or if it otherwise qualified to do so and it chose to do so, it could elect to be taxed as if it were an S corporation with flow-through taxation similar to the partnerships. And so If the facts were right, under the right circumstances, you could have a limited liability company electing to be taxed as a corporation and then electing to be taxed as an S corporation. And so it can get very complicated in these choices. And so it's very important to make sure you understand the various options and how your entity will be taxed.